Real estate investment trusts, or REITs, is often a market sector that dividend investors favor. With safe and steady rental income and high dividend payouts, many REIT companies such as O have become household names in the dividend community. However, not all REITs are the same, and some are better positioned within the marketplace than others. Given the current economic climate, I feel that there are a few REIT companies out there that will soon be forced to slash their dividends, and when this happens, it will also be accompanied by a similar reduction in the overall stock price. So if you hold any of these REITs, you may want to consider rotating out, or perhaps even short some of these companies if that is your cup of tea. Many REITs are struggling as a whole right now. While a residential loan for a house can typically be had for 30 years at a time, commercial loans are often much shorter time periods, with many loans needing to be renewed every 5 to 10 years. This constant need to refinance causes REITs to be more susceptible to interest rate changes, as being forced to refinance into a loan with less favorable terms can quickly cut into your bottom line. So first up on our list for today is Office Properties Trust, stock ticker OPI. OPI, like many of its office peers, has had a rough few years due to the pandemic shutting down a majority of offices, and the rise of telework, causing employers to rethink their need for a large physical office footprint. In a best-case scenario, employees return to the office and demand resumes. But in a worst-case scenario, the office sector is severely overbuilt. The reality is likely somewhere in the middle, but even within the struggling office sector, OPI is likely one of the riskiest companies because they focus on single-tenant, net lease office buildings. This means that if the tenant decides to vacate, the entire building sits vacant until a new tenant can be found. This process of finding new tenants often takes several months or even years, depending on the building. OPI has so far been able to keep its high dividend payments going, but that is likely to change relatively soon. Office leases are often signed for multiple years at a time, with 10-year leases being relatively common. However, 30% of OPI's leases are expiring in the next 2 years, which will likely cause significant problems for the company due to outright vacancies or necessary repairs. Next up on the list is Global Net Lease, stock ticker GNL. GNL is similar to OPI in that 40% of its business comes from single-tenant office buildings. Thankfully, however, GNL is slightly more diversified as it also owns some industrial properties. And while industrial properties as a whole have done very well in recent years, it is unlikely that GNL will see the same level of results. Many investors question the abilities of GNL's management team for raising equity at dilutive prices and then later cutting the dividend. But speaking of the dividend, GNL pays out a massive 93% of its funds from operations, which is simply unsustainable. Currently paying a forward-looking dividend of 13%, I feel that a dividend cut is imminent and investors should be wary of this REIT. Next up is Easterly Government Properties, stock ticker DEA. Like many of the previous REITs on this list, DEA is in trouble in part because it specializes in single-tenant office buildings. The good news is that it caters specifically to various government agencies that tend overall to be much less likely to vacate their buildings. However, this blessing could also turn out to be a curse, since it means that all of its tenants share one common factor: the government. The government is notorious for being inefficient. So having employees physically present in an office setting in a hope to be more efficient is less important for the government, and thus making these employees more prone to teleworking options. In the most recent status report provided to Congress in 2017, governmental agencies had been seeing a steady increase in both the number of employees eligible to telework as well as the number of days per pay period that these employees were teleworking. And this was all before the pandemic that caused teleworking to be the new normal. All job openings in the government are advertised on the website usajobs.gov, which lists nearly 8,000 government jobs that are currently available and allow options for teleworking. As we said, the government is notorious for inefficiencies. So paying full rent prices for a half-vacant office building may be relatively commonplace. But there does come a tipping point where threats of government shutdowns due to a looming debt ceiling crisis causes the government to rethink its spending habits and downsize out of their half-empty buildings. This could cause a large number of DEA buildings to become vacant at nearly the same time. Moreover, even if this exodus never materializes, DEA currently pays out a very high dividend payout ratio, which is simply unsustainable, especially after accounting for CapEx expenses that will be coming its way within the next few years. While I remain very bullish on the real estate sector as a whole, owning numerous holdings such as Avalon Bay, Equity Residential, Realty Income, and many others, not all REITs are worth holding on to, and sometimes you need to cut ties with companies that are unlikely to be able to help you achieve your financial goals. What REITs are you currently investing in? Leave a comment below with your favorite picks. If you enjoyed this video, consider subscribing, and as always, I'll see you all again next time. Thanks.